Hello traders, Igor here, MrTopTick.com. Today is Friday, January 13th, 2023, and it is an expiration date for one of our 112 bear traps that we entered 51 days ago. Just want to go over this trade. Again, this trade did not require a whole lot of management. Want to go through several points where I want to highlight a couple of things to show you what I look at and what my thought process when it comes to managing such trades. Also, I want to remind everyone that next Friday is the monthly expiration for the month of January. Every month we have a contest, if you will. You have to do two things in order to qualify. One, you have to subscribe to this channel. Two, you have to enter your name and your email address into a Google form. Link is in the description. We will randomly choose one person off that list and offer a 30-day access to one of our two trading services, Income Navigator or Active Trader Pro. That's going to take place next Friday. So if you are not subscribed yet, do so, and make sure to follow the link in the description to fill in your name and your email address, and we wish you best of luck next Friday. So we're going to talk about this 112 bear trap in the SPX. This trade was entered on November 23rd. We took a trade. This is a 5 lot. So what this trade was made of were two components. One, 30-point wide put debit spread. We sold a 38.50 and we bought a 38.80 puts. So that's a put debit spread. And then to finance this put debit spread, we sold 2 times as many 33.50 puts naked. So for every 1 put debit spread, we sell 2 farther out of the money puts naked. We end up collecting a net credit for this trade. This is a positive delta, positive theta trade, so our outlook has to be bullish. Now we can look at a chart to see what was happening at the time when we took this trade. Just looking at a couple of simple indicators. So we have 8 EMA, 21 EMA stacked bullish. We are above a 50-day moving average, and the price looks like is making a series of higher highs and higher lows. We have to assume that this near-term trend, which started sometime back in October, is to the upside. The way this chart was looking at the time, it looked like we were looking for a potential retest of about 41 or 41.10 on the S&P and a potential push towards 4,300. Now, if that would be the case, 4,100, 4,110 is not a problem for us because we do not have any risk on the upside in this trade. Doesn't matter how high we go. The only risk in this trade is if we trade lower. And two things. Number one, if we do in fact trade lower, we will benefit since we have a 30-point wide put debit spread, which could potentially end up in the money. So if we are going to trade lower, we just need to burn off enough time off the clock in order to get the full benefit of this put debit spread. Now, if the sell-off or a pullback happens relatively fast, say in a day or two, this trade will start to accumulate losses. So that's why we have a plan to manage this trade in the event that price does not cooperate and actually moves against us in the first couple of weeks in this trade. I'm going to go to the next adjustment point just to show you what we did. So this trade was entered on November 23rd. I don't think we have any adjustments until much later in the trade, and this is 44 days after we entered the trade. And this is what the trade looked like after we made a small adjustment, and this is what the trade looked like before we made the adjustment. So as you can see, 44 days were already burned off the clock. So our T+0 line is starting to come in, and eventually at expiration, our T+0 line is going to be this graph at expiration. So we are going to benefit if the price is somewhere inside 38.50 all the way down to where our short out of the money puts are, which is at around 33.50. Now I want to bring your attention here. This is where we made this adjustment, but I want to show you what this trade looked like as the market was pulling back. You can see we ran up to a 4,100, which kind of what we were looking for at the time of entry. We couldn't hold 4,100. We pulled back, and let's have a look at what this trade looked like on December 28th with S&P trading at around 37.83. So here we are. This is December 28th. S&P is trading at around 3,800. We are now in the trap. So as you can see, from where we took this trade, S&P has gone down about a 1 standard deviation, which is not an outlier move, but it is on right on the edge of the potential expected move based on the volatility at the time when we took the trade. But because we have 35 days has gone by, we have enough premium decayed in our short 33.50s, and now our 30 wide put debit spread is actually increasing in value, which is in our favor since we're long this put. The out of the money puts that are short are decaying, which is again also in our favor. So we have two components that are working in our favor, and a move lower is not as problematic as if this move happened in the first 2 days. So I just wanted to show that, right? So a move lower is not as scary as it may sound in the beginning. This is what this trade looked like. And then we go to the adjustment point, and I want to talk about why I made adjustment that I did. This is what it looks like before we made the adjustment. So going back and looking at the chart, right, we had a nice pullback. We kind of went back and forth for probably a couple of weeks. This is right at the end of last year. And now the price is back above 8 and 21 EMA while they're stacked bearish. This is kind of a no trend. We have a 50-day EMA up above. So this is kind of neutral as far as trend goes. But the price is starting to move out of our bear trap, right? This is our bear trap. So the price is starting to move outside. And with 7 days to go, right, it can go one of two ways. We could continue higher or we can continue lower. If we go lower, I get the benefit of the trap. If we go higher, I don't have any profit inside the trap. And best case scenario, if we move higher from here, I just get to collect the initial credit, which was $10.55 for putting this trade on. So what I ended up doing, I ended up closing 3 of the 5 put debit spreads. I collected $12.80 for each. And this is what this trade looked like after I made that adjustment. We can look a little bit closer. So from here, we can go one of two ways. We can go higher, and I'm going to collect the original credit, which was $10.55, plus whatever I just collected by selling 3 of the 5 put debit spreads. And if we are in fact going to trade lower from here, my benefit here is 2 of the 30 wide put debit spreads are going to be fully in the money, and odds are my out of the money 33.50 naked puts are going to expire worthless. We're going to go forward to where we are today. Our last adjustment, we can see that we were trading somewhere around, let's call it 3,900. From 3,900, as the price was moving outside of the trap, we knew that if we go higher, what's going to happen is our remaining 2 of the put debit spreads are going to expire worthless, and so will the far out of the money naked puts. So let's do some real quick math here to figure out what the P&L for this trade is. We started off with 5 of the 112 bear traps, collected $10.55 for each. I'm going to pull up my fancy calculator here. So $10.55 times 5 contracts collected $5,275. Now, this is not accounting for any fees or commissions, just to keep things simple. Now, we went ahead and we sold 3 of the 5 put debit spreads. We collected $12.80 times 300, which is equivalent to 3 contracts. So we'd collected $3,840. If we to divide this by 500 to make it equal to a 5 contract position that we are holding, we had collected an additional $7.68 plus the original $10.55. We have a total that we had collected for this trade, $10.55, the original credit, plus $7.68 that we had collected by selling 3 of the 5 put debit spreads. We have a total credit that we had collected here, $18.23. If we multiply that by 500, which is 5 contracts, our resulting P&L is $9,115. Now, if we have to back out fees and commissions for this trade, I think commissions on a 5 lot for this trade was somewhere around $12. So we can back out $12 and we end up with about $91.03. So that's where this trade is. We have all remaining options that are part of this trade are going to expire worthless. It is about 1:30 Eastern time. So in a couple hours, this trade is going to go away. We get to keep whatever we were able to collect. And next week, I have another trade that's going to roll off. I'm going to post another update. I hope you are enjoying these videos. I hope you're learning something new. If you do, please give it a like, subscribe to our channel. And as always, as long as you take care of the risk, the profits will take care of themselves. Until next time, trade 'em well.